German radio has just announced that Hitler is dead.
After the end of World War II in 1945, all parties except for America found themselves economically collapsed, and they needed aid that was provided by the United States, which has since become the largest economic power in the world. After World War II, the US domestic product rose from $200 billion in 1940 to $1 trillion in 1970, and due to this increase, the standard of living and income of individuals doubled. But in the late 60s, things got worse, so the prices of products and commodities rose. At the time, America entered an economic spiral that took 17 years to get out of it. This setback is now known as stagflation, which is an economic term that senior economists in the whole world have warned against in the coming period. So what is stagflation? Why did it happen in the 70s? Why do economists now warn of it happening? And what happened to the US in the late 60s? In the late 1970s, America faced a wave of unemployment and inflation. But how did these two phenomena occur together at the same time? Inflation is the rise in the price of products and the people's ability to buy them. But how can people buy goods despite their high prices and high unemployment rates at the same time? That is why inflation and unemployment cannot exist at the same time. The defect that enabled these phenomena to occur at the same time is that inflation can happen for more than one reason, such as high oil prices, epidemics, wars, and disasters. If these causes are internal, they can be treated and controlled. But if such ones were external, then the inflation could not be controlled. And when efforts are devoted to reforming inflation, we will find that unemployment rates are on the rise, which will lead to lower growth. The combination of these three elements is what is called stagflation. So what happened with the US in the 60s, and what does stagflation do really? During the Vietnam War, the US spent a lot of money on the military. And at the local level, the government spent a lot on social programs for the sake of entertainment. And with the beginning of the 60s, America was no longer the fortress of manufacturing in the world, and American manufacturers were moving abroad. All these factors created the perfect environment for inflation and unemployment. So how can the US deal with the high rates of inflation and unemployment? And most importantly, where is the role of the US central bank in all of this? The national bank at that time was very poorly managed. When inflation rose, the bank would raise interest rates, and when this raise affects companies that rely mainly on loans, companies would start to lay off people from work. As for the people, they complained directly to the politicians who were interfering with the economic situation in the national bank's management. As for the politicians interfering in the national bank's affairs, it is one of the most dangerous things that can happen, because it leads to a lack of confidence in the decisions of the central bank, which leads to a chain of interconnected events that start with the people convinced that the inflation cannot be eliminated, which makes them ask for raises. And the owners of the companies were obliged to raise their wages because if they do not do so, they would be the losers. And when wages are increased, the prices of manufactured products will be raised, which leads to more inflation and workers' discontent, so more demands for increases, and so on. All this happens because in the beginning, the workers were not confident in the ability of the central bank to control inflation. And with the outbreak of the October War in 1973 and the rise in oil prices, inflation reached very high levels. In 1979, it reached 15%. In that same year, 1979, a new national bank governor, Paul Volcker, was appointed. As soon as he was appointed, he took a step that was, at that time, considered political and economic suicide, which is raising interest rates to 22%, which is an imaginary rate that did not and will hardly happen again. And these are ratios that American companies cannot deal with. And this is what Volcker wanted to achieve, a deliberate economic recession and weakness. Unemployment at the time rose to 11%, which led to demonstrations and riots, and some members of Congress even threatened to dismiss Volcker. But he was a carrier in his policy, which began to succeed after a few months, and within 3 years, inflation indicators fell to only 2%. After this, he began to reduce prices and reopen the doors of the economy again, and things began to return to normal. And most importantly, he restored people's confidence in the national bank, and since that day, targets have been set to monitor inflation indicators, which are the 2% target. Well, now that we know what stagflation is, its effects, and solutions if the cause is that easy to control, as was the case in the US, when we hear warnings of new stagflation, we will say that the solution is clear and easy, which is raising the interest rates. But the increase in the interest rates will not have a significant effect if the factors causing inflation were external causes. such as the supply chain crisis, the Chinese shutdowns, the Russian-Ukrainian war, and the high oil and energy prices. And all these indicators made many economists warn of stagflation, and they say it is inevitable in the American economy. The US economy is currently in a critical situation and needs new solutions that are outside the box. Here we have come to the end of the episode, and our question to you is, in your opinion, what are the solutions that can be applied to avoid the stagflation crisis? Answer us in the comments. We hope you liked this episode. See you in the next.